Good morning, everyone, and welcome to the Nedgroup Investments Global Equity Fund Quarterly Feedback. My name is Anil Jagmohan, Senior Investment Analyst at Nedgroup Investments. The team at Veritas have been managing our global equity fund since 2010. Over the past 10 years, they have outperformed both the MSCI World Index as well as their global peer group, the latter by a significant margin of approximately 3% per annum. Joining me today is Antony Burgess from Veritas Asset Management. And please note that we have a Q&A feature available as well. Please send through all of your questions using the dialog box on the right-hand side of your screen. We will endeavor to address as many of these as possible before we close for today. If you have joined as an anonymous attendee, kindly submit your name via the chat so we can record it for CPD purposes. This session is being recorded and will be available online shortly thereafter. Thank you, and over to you.
Great, thank you very much, and thanks to everybody for joining. I'd like to spend about 30 minutes just to go through the last quarter's performance and the positioning of the portfolio, and then happy to take any questions on anything that I've been talking about or anything else that you'd like to ask. So first up, I'm just going to cover the 3 months and put it into perspective. So first off, a bit of an apology, I guess. I mean, we don't often have to explain a relative underperformance to the extent that we've seen in the last 3 months. And whilst I think most of you would have possibly expected us to underperform, if you know us well enough, we tend to do well in falling markets like the first quarter, keep up with moderately rising markets, and then underperform in sharply rising markets. And I think most people would agree that a 20% rise in 3 months is certainly a sharp rising market, and effectively a reversal of what we saw in the first quarter, and I'll come on to talk a little bit more about the positioning. But essentially, what I would argue that you've seen year to date is the shortest bear market cycle ever, and effectively investors have discounted a severe recession and the economic recovery before either of them have occurred, and that's a fairly dramatic position to be in. The chances are you can only be positioned one way, and as we are, we'll stick to our knitting. So let's explain this 3 months and put it into perspective. So on the next slide here, you've got the attribution by sector. So the first thing that I want to draw your attention to on the right-hand part of the table is the total effect. So you can see that the shortfall has largely been made up of an asset allocation effect. I mean, there has been some shortfall in stock selection, which I'll come on to, but you can see that the bulk of it has been asset allocation, which is not what we do. This is a byproduct of our stock selection. We pick the stocks that we think are the best value, and that will dictate where we are from a sector point of view. But the reason for underperformance in the second quarter is, one, we're very underweight in information technology. You can see 4% versus 20, and that was the best performing sector. We're underweight in materials. We tend not to like material companies. That was a good performing sector. And lastly, consumer discretionary, things like car companies in the States, you know, we just wouldn't touch with a barge pole. And as you can see, that was a very well-performing sector. And on top of that, the biggest weighting in the fund is the healthcare sector at 30% versus approximately half of that. And that was the worst performing sector in the second quarter, tends to be very defensive by its nature. So the sectoral positioning really wasn't in our favour. So what about the stocks? As I mentioned, to be fair, there was some stock selection shortfall. So if we look at the next slide, these are the positives and negatives. So the really good news here is that there's been absolutely no blow-ups. You know, there are no companies that are in trouble most companies are operationally doing extremely well. Clearly we keep a close eye on it. There are one or two companies that, we need to look at in closer detail. But ironically, the one company that had potentially the worst bit of news over the quarter was Facebook, which I'm happy to cover in questions, but to do with people boycotting advertising in July because of various hate campaigns. And yet the stock was up 30% and one of the positive contributors to the quarter. If we look at one other positive, Sonic, this helps set the scene to show you how fickle things are at the moment. I mean, Sonic Healthcare is a lab pathology and radiology company, operates in 8 different countries, and it basically does diagnostic testing. So we like it because diagnostic testing is basically 2% of healthcare costs, but it dictates where the majority of the rest is spent. So it helps to take cost out of the system. In the first quarter, they operationally didn't do so well because there aren't so many blood tests and genetic tests going on. But there are a lot of COVID tests going on, which Sonic is involved in. So when they came out with their results, they basically said, we haven't done too well for this reason. The COVID tests haven't really offset the shortfall in the other tests that we're seeing at the moment during lockdown. However, looking forward, we actually think that we'll do very well because testing is going to be a substantial part of coming out of lockdown. In fact, in the words of the Director General of the World Health Organization, it's all about testing, testing, testing. So Sonic should do very well from that point of view. So despite the numbers not being so great, the forward-looking statement was positive and the shares did very well. If we contrast that by looking at a company like Cooper's, Cooper Company does 2 things. It's involved in contact lenses and it's involved in fertility treatment. Now, the contact lens market is massive. It's a $9 billion market. And there are various long-term trends that we like about that particular business. One is myopia. Some of you may have heard me talk about this when I was last in South Africa, but myopia is reaching epidemic proportions. It's short-sightedness. 50% of the planet will be short-sighted by 2050. The number is already 80% plus throughout most of Asia. I haven't got time to go through the reasons why, but it's a particular growing issue. Secondly, more and more people are using daily silicone hydrogel lenses. These are much more comfortable than the older lenses, and there's as people come on to wear contact lenses, there's a growth market in that area, and Coopers have the widest offering. Thirdly, there's a trade up. People are moving to disposable daily lenses from longer term lenses, particularly if they play things like sport, and the lenses are getting better. And lastly, there's a growth in things like multifocal lenses. Lenses are becoming much more sophisticated and a bit like glasses. They can now accommodate for short and long sighted in one lens, something that wasn't there before. And so that, again, there's a big take up in that area. So Coopers basically have been doing very, very well, growing at 5-6% per annum. Now, they haven't had a great time since COVID for a number of fairly obvious reasons once the company states them. One, opticians are closed, so the new take-ups aren't happening. So that's affected about 15% of revenue. There are people like me. If I'm on screen, you'll see me with a pair of glasses. I'm not wearing my daily disposable contact lenses. I'm sitting at home. I haven't worn a lens for 4 months. And that's quite common for most of their customers. And lastly, a lot of opticians are running down their inventory of stocks. So in the short term, they've been impacted by COVID, but the longer term trends are still there. So their forward-looking statement is, the future looks bright, but we don't know when. It really depends on when we come out of lockdown. So the fact that it wasn't a positive statement weighed a little bit heavily, and so the shares did go up, but not as much as the market. Now, the same is true of something like Unilever, which you see down there. Now, Unilever had flat revenues over the quarter. Now, they have, it's a tale of two halves, if you like, that half of the business is involved in things like ice cream. They do Ben and Jerry's, and obviously with people not going out as much, eating less ice cream, then you've got things like hair washing, skincare, and deodorant. So they have brands like Pond's, Shaw, and Dove. And incredibly, there's been a huge drop-off in these products. As people are sitting at home, they're not using these products as much. And the sale of deodorants has gone through the floor. People are just not bothering because they're not leaving the house. And that's netted off by their cleaning products, things like Domestos and Civ, where there's been a greater take-up. Now, it's unlikely that those staple products that I've just mentioned are not going to be in demand in the future. But again, with a little bit of uncertainty in terms of how long lockdowns are, etc., there may be some short-term effect on the business, but it doesn't affect the longer term trend, and particularly the growth of the business in emerging markets. And the fact that the company is 60% geared towards emerging markets is something that hasn't gone in its favour in the last 3 months. And I could go through this list. In the case of Cigna and Baxter, two healthcare companies, both of them actually produced results during the quarter which were much better than expected. In fact, there was nothing wrong with them at all. Far exceeded expectations, but the shares lagged because they're not really in that kind of sexy growth area that people were looking for during the quarter. So, what are we looking here? What are we talking about in terms of the backdrop for markets? Well, as we know, COVID really developed back in January, and the response of most countries was to initially go into lockdown and protect people, but mainly protect the health service from not being able to cope. And the byproduct of that was a whole raft of things, particularly regarding health, things like elective surgery, whether it's anything that could be put off by a month or two was, and obviously people weren't going out. And so it became obvious that there was going to be a massive effect on the economy. It was doing the right thing, but the economic fallout was going to be potentially substantial. So because of that, we've had the most substantial fiscal and monetary policy response ever. This chart shows you the fiscal stimulus as a percentage of GDP. And if you look at the States, for example, it's up at 13%, which is more than the 3-year period when we went through the global financial crisis. And you can run your eye along that line and see that the response has been fairly dramatic in other areas as well. So, lowest or loosest fiscal policy since World War II. So this clearly is something investors have latched onto. Governments are going to do whatever it takes. There's going to be this promise of support for years to come. And what that's effectively done has discounted recovery, and the best performing sectors have been those that I mentioned earlier, which are leveraged towards economic growth, mainly consumer, discretionary, materials and technology. So to illustrate that, I just want to go through a couple of slides that Goldman Sachs put together, so it's independent. This shows you the average, so this is a basically valuation, if you like, of the US software sector. So this is one of the common ratios looked at for valuation, particularly for tech companies, which is enterprise value over sales. NTM is next 12 months, so this is forward looking. So enterprise value over sales effectively is what it's asking you is how much it costs to purchase a company's sales. That's really what the ratio is telling you. So what you can see here is that prior to the fall off from COVID, that this sector reached a peak of 12.5 times. It then got derated by 30% and fell to 8.5 times, where it looked attractive, relatively speaking. And now you can see that we're at nearly 15 times. There's been a 75% multiple expansion within that sector since that stimulus and the recovery in the second quarter. So it's now more expensive on this valuation than it was prior to the fallout, and even before, when we arguably thought it was expensive. So if we then break this down into the different component parts of the tech sector, what this is showing you are those companies that are split into hyper growth, high growth, mid growth, and low growth. So these are the different tech companies, and that's defined by the actual growth rate. So hyper growth are those that are growing at over 40% per annum, and then you've got that's hyper growth. Mid growth is 25 to 40. Then you have 25 so 15 to 25, and then lower than 15. That's the parameters by which these were measured. So companies within the hyper sector, and here are the tickers down the bottom here for each of the companies. But Zoom, for example, is in the hyper growth sector together with Shopify, and then about 14 companies are in the high growth sector. You've got companies like Cloudflare, Slack, Okta. These are all kind of rather trendy tech companies. Now, as you can see, this again shows you what we saw on the previous slide, but broken into these different buckets, if you like. So each of them having this bit of a derating and then this re-rating since the stimulus has taken place. Now, if we take this line here, which is the high growth, this is made up of 14 different companies. And of the 14 companies, only two have made a positive operating profit in the last reporting earnings season. A company called Alteryx and a company called ServiceNow. One made 9% earnings, the other positive, and the other made 1%. If you take the average earnings margin across all 14, it was minus 26%. So effectively what you're really saying here is that either these things are exceptionally overvalued, or you're looking for substantial growth from these companies in the future that will justify these earnings, which could happen, but it's more likely to happen to the odd one or two rather than all of them. And we're not in the market for buying these types of businesses. Buy 10, one makes it, two makes it, the others don't. We're looking for dependable cash flows and earnings. So where does that leave us in terms of the portfolio over the 3 months? Well, first of all, there were no new purchases. We did add to some existing positions. We did buy some of those companies that had lagged, like Coopers. We've been adding to because we think they now look particularly cheap on an IRR basis. And the only complete sale was Amazon. Some of you may remember from last time, we tried to buy Amazon when we deployed the cash in March. And unfortunately, we only bought about 8 or 9 shares, and so it wasn't worth keeping them. We're not going to get an opportunity to buy it at the right price, and so we sold those few shares that we did buy at a substantial profit, but unfortunately it doesn't move the dial very much. So where it leaves us in terms of the portfolio breakdown at the end of June is shown on this slide. 29 holdings, You can see the cash level is still low. So one thing I will say actually is, we did deploy most of the cash in the first quarter, as some of you may remember. So, the shortfall in the second quarter was not because of holding cash, which obviously would have caused a drag. In fact, everything that we bought has done substantially better than cash. There's only one company, Becton, which has really lagged the market. The others have actually exceeded it. So, the stocks that we bought, have been doing well. So the top 10 here, as you know, are the companies that we think offer the best value, and that dictates where we are from the regional and that sector weighting. So again, just re-emphasising that, no materials at all. We just don't think there is dependability and visibility of cash flow in materials or oil companies, coal companies, etc., mining companies, utility companies, so we don't tend to invest in them. So there's no materials, very lightweight in consumer discretionary, which did well, and lightweight in information technology. In fact, believe it or not, that 4.1% in information technology is MasterCard, which is classified as an IT stock, and it did do well in the second quarter. But clearly we've now sold out of Microsoft. We sold out of it in January. It fell, and now it's above the price that we sold it at. Because people are latching onto the fact that more and more people are using Teams. So valuation's gone out the window. It's this perception of which companies are benefiting from the situation that we all find ourselves in, and not making any assumption of error at all. Microsoft has to grow at 15% per annum to justify its current valuation, which we just don't see happening right across the board. And then, as you can see, healthcare, very large position at 31%. That was the biggest underperforming sector over the quarter, and hence one of the reasons for underperformance. And you can see a number of the names in that top 10. So with that, I think I'm 25 minutes in, so I'm a little bit short on time, but I'm very happy. I was going to cover Facebook. Maybe I'll do that in questions and answers, but I'll just see if there's any questions that anybody would like to ask.
Thanks, and yes, there are a couple of questions here. So the first one is just about US valuations and just your thoughts on being in US equities now, just given how high the valuations appear to be.
Yes, no, I think it's a great question, because we would agree with the questioner that valuations in the US, if you look at it as a region, look particularly stretched. But a lot of that is distorted by some of the, particularly the tech sector. So again, I would emphasise the fact that this is very much a kind of rifle shot approach, if you like. We're looking at it from a very stock specific basis. So if you look down that top 10, Charter is US, Alphabet's US, MasterCard is US, United Health is US, Baxter's US, Facebook is US, and Thermo Fisher is US. But each of those companies are, the range would be from 11 all the way up to sort of 20% IRR. Whereas we think that the universe of stocks that we're picking from, the IRR is now back down, to sort of 4 or 5% level. So we think there's a low return from equities at current valuations. Obviously, it's going to be volatile, but some of these companies are offering particularly good value at this point. So maybe just to give you a quick example, one or two of the positions that we hold, particularly in healthcare, have been held back, particularly like United Health. They've done well in the last 12 months, less so in the last quarter. But remember, some of these companies have had a bit of an overhang from the fact that we have a US election coming up in November. And now it's a shootout between Joe Biden and Donald Trump. If you believe the polls, which have never really got it right in the last few years, it looks like Joe Biden will win. but it doesn't really matter from United Health's point of view. What would have impacted United Health is somebody like a Bernie Sanders, who stepped down from the race, winning the presidential election because he wanted to do away with insurance companies. So having had CVS, Cigna and United Health, these companies have now got much more of a clearer runway ahead of them, with that uncertainty taken out of it. So as you can see, things are pretty stock specific. The other thing about those is they're very US centric. They're not going to get tied up with the US-China trade war, which people seem to have forgotten about, and as there are some implications. They're less dependent on the economy and recession. They will grind out irrespective. The one area that they will lag in is like the one that we've just had, where people are focusing on higher growth areas, because these things will churn out 5%, 6%, 7% per annum growth, as opposed to the sort of 15% plus that some of the sexier IT names may potentially do, which is what people are focused on in the last 3 months.
Okay, thanks. And just, are you expecting another market pullback at this point, just given how quickly things have shot up?
Well, I mean, it's difficult. I mean, I think what we would say, I mean, it's very hard to predict whether we'll get a fall. I mean, the only thing that we certainly think it will continue to be volatile. I mean, the situation we find ourselves in, as some of those slides will have shown, is that, we're now discounting a recovery from a recession that hasn't even taken place yet, and we are going to have a recession. And there is people are just latching on the fact that the medicine is now being turned back on again, and it's going to be there forever. But of course, that's not necessarily the case. Not everybody's going to get bailed out by it. So the situation we find ourselves in, that we are discounting a rather relatively rosy scenario as far as recovery. So a bit like some of those tech names, not focusing in any negative news. We would say that that's the case with the market. So it is vulnerable to fluctuations. And so what we're trying to do is just to say, look, we can't predict where this is going in the short term, but what we can do is we can look out 5 years and say which are the companies that are most predictable. And actually, if that visibility goes, that's the reason we would sell it, rather than worrying about the fact that no one's going to an optician at the moment, because that's not, that's not long term. That will change. Or no one's, less people are having heart operations. At some point they're going to have them. Or fertility treatment. Those that need it are likely to have it at some point in the future. The situation we find ourselves in today is that everyone's assuming that we're all going to be on Zoom forever, or Teams in this case, forgetting that Microsoft does other things, and there are other parts of the business that might well be impacted by what's going on. And we're already starting to drift back to the office. I think that Teams has its limitations. I don't personally think that we're going to have a world in the future where we're all using Teams. Only 20% of flights rely on business. People are ignoring the fact that it's 80% is leisure. And discounting, the aerospace sector and the fact that it's, it's dead in the water. We don't see that being the case on a longer term perspective. But who knows over 3 to 6 months? It really depends on whether we get another wave. I mean, the other thing that's not factored in, as I think you know only too well over there as we do here. You get pockets of flare-ups of, they might not be second waves, but there's localized flare-ups in COVID. That's likely to continue. I mean, if you've seen the pictures from some of the beach resorts over here since we relaxed lockdown, I mean, it's crazy. I mean, there's no way people are social distancing. So, the chances of having some other potential shocks must be there, and none of that is being factored in at the moment.
Thanks, Ant. And you mentioned about a lot of the fiscal stimulus measures in place. What about some of the monetary policy measures that are being implemented around the world? What are some of the complications that will arise out of that?
Yeah, I think that's the other thing, because obviously there is substantial support there as well, whether it's in keeping interest rates at very, very artificially low levels, and that obviously does have implication for banking sector. There are a couple of companies, for example, in China that we were quite interested in, sort of Ping An, where you've got this growing emerging wealth, but actually a very low interest rate environment does have implications for those types of businesses. You've obviously got things like cuts to things like VAT, with holidays, stamp duty holidays to try and stimulate property markets. We've just had one here actually, which can be worth up to $100,000. If you buy a house, you've got there's a discount. It's tiered on the stamp duty to try and kickstart that. But of course, the interesting thing is actually that it doesn't discriminate either. It's not just first-time buyers. So what you may find is that it's the wealthy that can afford to buy another place that will do it. And yes, there will be some multiplier effect from that. But that might just actually widen any margin that there is between rich and poor, for example, that people are concerned about. There could be some very big social outfall to what's going on. Some of the policies are quite indiscriminate in terms of, it's just like let's throw everything at it to try and kickstart, without being a little bit more, again, sort of specific in some areas. I mean, that's difficult to do. But there will be some longer term implications, some winners and losers from that scenario.
And just your view on Europe at the moment, which already before this whole COVID period was going through a bit of a tough time, and just seems like it's in a worse situation now.
Yeah, I mean, we don't look at sectors from a regional point of view. It is very stock specific. You'll notice on the slide that's up here actually that about 19% is of the holdings are in Europe, but again, it's very stock specific. Not looking at Europe per se. I mean, I suppose the one area that we have, the one company that is impacted by what's been going on is Aena. They're both aerospace really, Aena and Safran. I mean, Safran makes the engines, and Aena is Spanish airports. But again, things aren't as gloomy as might first be perceived by the industry that those are in. So, I mean, for example, Spain is now opening up. We can now travel to Spain on holiday, and there's no, you don't have to isolate for 2 weeks on either side. So that we have agreements in place with most European countries to for that to occur. Now, of course, that may increase the risk of another flare-up. But again, it's an example of how countries are so desperate to stimulate growth. And you're right that Europe, certain parts of Europe, including Spain, have very high levels of unemployment going into this. So, the reason why they've thrown so much money at it is obviously to try and put the economy into incubation so that it kickstarts again as soon as what we're seeing now happening, things opening up again, rather than people losing their jobs, businesses closed. So there's nothing to kickstart once once things start to reopen. So there are. I think we think that things like Aena will over the long term do well as people do travel more to countries like Spain. They're regulated anyway, and they were due to have a significant cut. That each few years that they apply a discount, or there's a limit to how much they can put prices up. And of course, that's been taken away given what's just happened. So ironically, they're in actually quite a strong position from a solvency point of view. So, and they operate just about every single Spanish airport. So once people start going through them again, and there's landing slot fees and duty-free sales, they should kickstart quite quickly. And the same with Safran. Safran gets most of its revenue from servicing engines, so they don't have to sell an engine. They just they can do well just by servicing the ones that are already there. In fact, they lose money when they sell an engine. They make all their money on servicing and parts. So as soon as people start flying again, that revenue will kick in quite quickly. So the difference here is that these things are very, very cheap. People aren't, because the visibility is not quite in the short term, is not there. What we're seeing is people focusing very much on a 12-month, 6 to 12-month view. So it's all about tech and people being stuck at home. What are they doing at home? Who's benefiting in the short term? And because there isn't that sort of greater visibility, or people not wanting to look further out, anything that's likely to do well on a longer term period is a little bit more suppressed, and that does include some of those European names.
And just your team's assessment on the potential negative implications of a Democratic presidency in the US on some of these larger IT firms from a regulatory perspective and so on.
Yeah, I mean, I think again that's a fair question. I mean, I think it would have been worse if it had been Elizabeth Warren or Bernie Sanders, who really were gunning for not just health insurance, but also Alphabet, Facebook, that they wanted to split. And actually, believe it or not, some of the rating agencies like Standard & Poor's, where their view was that these companies are the ones are being paid to be rated, which is rather incestuous, but that's been the case for 100 years. So anyway, looking at Alphabet, Facebook, and the like, there is some regulatory pressure. It doesn't really matter who is in power; they're under the spotlight. If they were broken up, which is one scenario that people are looking at, that they're actually worth more, particularly Alphabet. If you break Alphabet up into its component parts, it's worth a lot more than it is today. They've got Waymo, the driverless car business, which is not worth anything as it's packaged up within Alphabet. But if you stripped it out and you put the value of some separately quoted businesses in that area, it would be worth quite a lot. And if you go through the sort of 14, 15 different sort of businesses that Alphabet owns and did the same sort of breakup value, it's worth substantially more, than it is today. And actually, we think that arguably it's better together in terms of regulating it. Anyway, I mean, Facebook is the one that's very much in the news at the moment. It tends to always be, because nobody particularly likes it. Well, certainly the press, and it is one that we've taken a closer look at, but more recently, just because of the campaign that's been going through, the Stop Hate for Profit campaign. That some of you may be familiar with. So, I mean, Facebook has just announced that it now has 3 billion people on using one of its apps, whether it's WhatsApp, Instagram, or Facebook. I mean, 3 billion out of sort of 7.5 billion people is pretty impressive. So that number's been going up. The advertising's been hit a little bit by COVID, but not as much as people had anticipated. But the big news more recently, which throws it in the spotlight, is this accusation that they're not doing enough about hate speech and misinformation and voter suppression, and hence this campaign Stop Hate for Profit emerged. And what they've tried to do is say to advertisers for the month of July don't advertise on any of Facebook's platforms. And actually the news has been that some of them are doing just that. So Unilever, for example, has said that they're not going to advertise. There's about 50, 60 names, and some of them are pretty well known. But obviously the pressure is on those companies, particularly from a corporate governance point of view, to be seen to be doing the right thing. But to put this in perspective, there's two things. People forget that there are actually 8 million companies that advertise on Facebook. 8 million. And if you take the top 100, which would include companies like Unilever that spend the most, last year they spent, what is it? I've got it written down here, $4.2 billion, which equates to 6% of Facebook's revenue. The reality is Facebook is dependent on small and medium-sized companies. They've got literally thousands of them, where it's too expensive for them to go and advertise on TV, which Unilever can do. So they make they make a very, very high return on their investment by using things like Instagram, which in some cases can be very cheap. Some actually don't. They do a little bit of advertising, but they get a very big bang for their buck just by placing stories and things that aren't advertising, and they don't pay for. So that's the first point. The second point is that actually you shouldn't believe everything you read. The European Commission came out with a separate report recently, which basically stated that Facebook in the last 12 months has taken down 95.7% of hate speech related content within a 24-hour period as an average, whereas Twitter did 76%. So it's not that they're doing nothing. Now, clearly they can do a lot more. And unfortunately, Mark Zuckerberg didn't help himself when he came out with a statement along the lines of, well, they'll be back. And he's probably right. These companies need Facebook as much as Facebook needs them. If you want to tap into 3 billion people around the planet, there is no alternative. But they will have to do more. They are starting to do a lot more. We think that will escalate, and people will end up coming back, and it will be an issue a little bit like the YouTube issue back in 2017. But whether that is, the noises will be rumbling on about, breaking the business up. When you actually speak to lawyers and what can actually be done in terms of, are they really snuffing out competition? That's a very, very difficult thing to prove. As I mentioned, a lot of companies have set their whole business up by going onto Instagram. Fevertree, the tonic water, did it. There's about 100 companies that are now earning a lot of money where they started with next to no cash to spend on advertising, that set their businesses up through Instagram. So that hardly constitutes snuffing out competition. In fact, anything, it's lowered the barriers to compete with the likes of Unilever and other branded goods in things like shampoos and drinks and etc. So it's going to be very, very hard, very, very hard to prove. But sorry, long-winded answer to the punchline that those running for the Democratic presidency at the moment are probably more benign than the ones that were proposed 12 months ago.
Okay, that's all we have time for, and thanks very much to you and your team at Veritas for your outstanding efforts in managing the Global Equity Fund on behalf of our investors. To everyone on the call, throughout this week, we are hosting our global fund managers for updates on our award-winning offshore range. Please look out for the invites to these events, and please feel welcome to contact your relationship manager for any further details. In this regard, please join us this afternoon at 4 p.m. as we speak to FPA for an update on our Global Flexible Fund. We look forward to connecting with you again soon. Thanks very much.
Yep, and thanks very much from me.